Hey everyone, Chris here with 1406 Financial here with an explainer on why you'd ever choose between corporate bonds, government bonds, fixed annuities, a bond fund, or a money market fund. So hang tight. There's a lot of material to cover, but let's get into it. So let's see. When you're describing or trying to compare investment products, there's a couple things that make it really difficult to make videos for. And that's the compliance disclaimers, right? So what I'll do here is let's just go through what the compliance requirements are, and I'll go through all those disclaimers first, and then we'll get into the substance of the material. So what I'll do is switch to the screen. All right, that's where it is. Now let's keep it here. One sec. All right, here I am. Can I be on this side today? Oh, maybe this side's better. Okay. So there's some SEC requirements when you compare investment products. And any comparison between investments, I'm just going to read it. I mean, I got to get through this compliance stuff, so let's just read what compliance wants, and hopefully I can get this through. So any comparison between investments or services must disclose all material differences between them, including as applicable investment objectives, costs and expenses, liquidity, safety, guarantees or insurance, fluctuation of principal return, and tax features. All right, so those are things I need to do for SEC requirements. And I do have those on a grid here for us, but let's also get into my firm's requirements, which are, here, they're in the same document. Which pertain to each particular investment instrument. So again, this is from our compliance guide. I'm just going to read you what I need to disclose to you when I talk about these investments. And so for corporate bonds, all communications and advertising regarding corporate bonds must adhere to the following guidelines. I need to state that the market value of the bond will fluctuate, and if the bond is sold prior to maturity, the investor's yield may differ from the advertised yield. All right? And if you hold the bond until maturity, the bond will continue to pay the stated rate of interest as well as its face value upon maturity, but is subject to default risk. All right, so that's for corporate bonds. For government bonds, when communicating about government securities, the following guidelines apply. Use of the phrase risk-free rate must clearly define which U.S. Treasury is being used as the benchmark. Risks that could be associated with the security, for example, interest rate risk, inflation risk, and include the appropriate guarantee language mentioned below. When describing Treasury bills, income, the discount feature must be explained, and it must not be implied that these securities are interest-bearing. Well, I'm not going to talk about discount securities today. Everything I'm talking about is interest-bearing. So for risk safety discussions, while there's virtually no liquidity, credit, or default risk, explain that Treasuries may still face interest rate risk or inflation risk, especially in the longer term. All right, so U.S. Treasuries are known to be are considered the safest investment in the world and the highest quality, so there's virtually no liquidity, credit, or default risk, but there could be in the future. There have been hiccups in the system. U.S. government could default in the future. I pray that they don't, but you can never say never around here. When a communication makes reference to guarantees, the following language is necessary. U.S. Treasury, explain that the securities are guaranteed as to timely payment of principal and interest, okay, and government agencies, unless the agency's security is fully guaranteed by the U.S. government and disclosed similar to Treasuries as noted above, an agent's security will need to describe what is guaranteeing the security, if at all, or otherwise note that they are not backed by the U.S. government. Okay, well, I'm going to focus on Treasuries today, Treasury notes, 5-year notes, so I'm not going to do agencies. And when citing current yield, the lesser of a yield to call and yield to maturity must also be given with equal prominence, and the date must be current. Okay. All right, great. That was a mouthful, but I'm going to focus today on 5-year non-callable securities issued by the U.S. Treasury. Fixed annuities, insurance and annuities here. All communications and advertising for fixed annuities must adhere to the following guidelines. Features and benefits should provide explanations appropriate for the audience, which may involve defining key terms. Well, I'm going to try not to get too technical here today. Just general stuff. Avoid the use of terms that would associate the annuity with bank products, securities, retirement plans, or other non-insurance products. Language should also not imply that the annuity is affiliated with a government entity, right? So annuities are known as insured or guaranteed products, but they're insured and guaranteed by the issuing insurance company. They're not FDIC insured, not bank insured, not insured by the U.S. government. And although there's a big annuity guarantee association out there, they are not going to give you all your money back. It just doesn't work that way. So they're only guaranteed by the issuing company. That's why insurance ratings are extremely important. Potential tax advantages should be explained and include disclosure of restrictions, penalties, or other circumstances that may affect the tax liability. And discussion of the withdrawals will include that withdrawals are subject to ordinary income tax and if made prior to age 59 and a half may be subject to a 10% IRS penalty, that withdrawals may reduce the benefit and contract value, and that surrender penalties may apply. Okay, we're going to cover a lot of that. Now for money market funds. Hold on, please. All right. All communications and advertising regarding a general discussion of money market funds must consider the following guidelines. They invest in high-quality short-term debt instruments. They seek to maintain a net asset value of $1 per share, but are subject to liquidity fees. Well, in some circumstances, yes, not all the time, okay? They are not FDIC insured and don't guarantee principal. They're not bank insured, government insured. They're not insured by anybody. They're only as good as the fund. They aim to generate income but have little capital appreciation as returns are dependent on interest rates, right? And income generated by the fund is either taxable or tax exempt depending on the types of securities invested in. Well, I'm just going to do taxable money market funds, okay? So right now, we're at a peculiar time with regards to rates and all that, and that all these products, government bonds, corporate bonds. Can you see me there? I feel like I'm really close to you guys today. Okay. Can't see my hands. I do all these things with my hands. Government bonds, government corporate, fixed annuities, money market funds, and bond funds are all extremely close in rate, I hesitate to cite rate because that probably creates some sort of compliance thing I'm not aware of. So they're all very close in rates. And being that I'm recording this March 29th, 2024, rates are commensurate with what's available in the market now, and they're all very similar. So you can go look up for yourself what rates are on these products and see that they're all very similar. So when rates are different, it makes the comparison seem easier. You buy the product with the higher rate. It makes it seem easier. Buying the higher rate's not always the right answer because you might buy a product that has a higher rate and then it drops in value and your total return is a lot less than had you taken the product with the lesser rate that doesn't drop in value, right? So you have to consider the total return for your holding period to figure out which one of these might work best for you, right? So when we compare these things, let me get up on my screen now, the comparison that I created to appease the SEC requirements, all right? And so again, from the get-go, we talked about if you look down the left-hand side, things that you need to be aware of when you compare investment products are investment objectives, costs and expenses, liquidity, safety, potential guarantees, fluctuation of principal or return, and tax features. Now, I've thrown in some bonuses here. Reinvest the interest and beneficiary protection. We'll talk about that in a minute. But in a comparison here, let's just go through what I've created and hope this gets through. If you see it, it's gotten through compliance. Well, at any point you see this, it'll have been massaged to get through compliance, but these are just all the disclaimers. So the investment objective of a corporate bond is to pay interest and face interest, interim interest, I should make this say interim interest, pay interim interest and face value at maturity. And I would say that's the same objective for a government bond. A fixed annuity's goal is to preserve your capital, pay you interim interest, and then grow your money. I mean, it's growth through interest, not growth through principal appreciation, but growth through interest. A bond fund seeks to track the performance of a broad market-weighted bond index. Well, actually, today I'm going to talk about a bond index fund. Okay, so let's be clear. I'm going to do a bond index fund. And a money market fund, the language for the funds here was taken right from a specific index fund and specific money market fund prospectuses. I'm really just cutting and pasting from what a prospectus would say, and you can see this in the prospectus of these products. I can't say which bond index fund I'm referring to or whose money market fund. I can't say names because that creates other compliance issues. So these are just generalizations that A money market fund seeks to provide current income while maintaining liquidity and a stable share price of $1. So cost and expenses. In a corporate bond, the bond itself has no operating fees or expenses. However, you may pay a commission or fee to an intermediary to buy or sell, right? So you might pay someone like me, a commission to buy the bond. If a firm like mine's working for you on a fee basis, obviously that your bond goes into an account where a fee is being paid, so that the fee. I mean, if you want to really slice and dice, the fee should be taken into consideration, but the bond itself has no operating fees or expenses. Same with the government bond. The bond itself has no operating fees or expenses, but you may pay a commission or a fee to an intermediary buy or sell. A fixed annuity has no investment management fees or expenses, but an annual contract fee may apply. And if you buy an optional rider, you may have some additional fees. So we're just going to today talk about a straightforward point-to-point fixed annuity. The only way I can think of is if there's a cost to do this is if someone like me charges like a annual account fee, or some annuities, if you get below $50,000 on your account value, they charge you $50 a year. But a fixed annuity itself, a point-to-point straight fixed annuity with no shenanigans, has no fees or expenses, just an interest rate. All right. So a bond index fund, you may pay shareholder fees and annual fund operating expenses if you buy, hold, and sell shares of the fund. You may pay other fees such as brokers' commissions and other fees to financial intermediaries. Again, you may pay someone like me a fee or commission. Same with the money market fund. You may pay shareholder fees and annual fund operating expenses if you buy, hold, and sell shares of the fund. And you may pay other fees such as brokerage commissions and other fees to financial intermediaries, right? So you just got to know these things. Liquidity. A corporate bond is daily liquidity subject to market conditions. Happens to be Good Friday. You can't sell any bonds today. So if you call me and ask for money, it's going to take a few days to get money. So corporate bonds they have daily liquidity, but subject to the markets being open. Same with government bonds, daily liquidity subject to market conditions. A fixed annuity has liquidity all along the way, but surrender charges typically apply. We'll talk about that. Bond index funds have liquidity risk, and that's the chance that the fund may not be able to sell a security in a timely manner at a desired price. And bond index funds go up and down liquidity. Well, you can sell a bond fund every day. The stock market's open, but the pricing may not be favorable, or the bond market's open. Same with a money market fund. Liquidity risk is the chance that the fund may not be able to sell a security in a timely manner at a desired price, and it affects your overall fund price, right? So the liquidity with bond index funds and money market funds is any day. The bond markets, money markets are open. You can sell these. However, asterisks, you may not sell it at the price that you want because there's been some sort of situation that's driven prices down. I think that's really what they want you to know. So safety. A corporate bond safety is subject to default risk. There are rating scales issued by rating agencies, and so the higher the rating, the less risk of default. All right, but so you have to know that a corporate bond may not pay you back. Okay, same with the government bond. U.S. government bond still subject to default risk. The U.S. government has never defaulted on an interest payment or a maturity payment, but never say never. All right. Fixed annuity, your investment safety is based on the claims paying ability of the issuing insurance company. So annuity companies, just like corporations, have credit ratings, and you might get a better rate from a lower rated company. Same with a corporate bond. A lower rated company is going to pay you more than a higher rated company, so you need to assess this when you buy these things. A bond index fund, an investment in the fund could lose money over short or long periods of time. You should expect the fund's share price and total return to fluctuate within a wide range. It's saying bond funds go up and down. So the safety is, you got fluctuation, you got securities may not be able to be redeemed. I mean, they're diversified products, but they're not guaranteed, right? Money market funds, the fund is designed for investors with a low tolerance for risk. However, the fund is subject to several risks which could affect the fund's performance, right? There's liquidity risk. I mean, there's interest rate risk, all sorts of risks with a money market fund too. They're not guaranteed products. So potential guarantees, right? Potential guarantees, corporate bond, none. Government bond, none, right? A fixed annuity has guarantees by the issuing insurance company. A bond index fund has no guarantees. A money market fund has no guarantees, okay? So, again, is the interest rate on a corporate bond guaranteed? Well, it's as good as the issuing company. So you would expect to buy a high-quality bond from a name you know and get all your interest and your money back at maturity. However, there's no guarantees. All right. So fluctuation of principal or return. All right. The market value of the bond will fluctuate, and if the bond is sold prior to maturity, the investor's yield may differ from the advertised yield, right? A corporate bond goes up and down every day in the market. We're going to go into a graphic about that. Same for a government bond. The market value of the bond will fluctuate, and if the bond is sold prior to maturity, the investor's yield may differ from the advertised yield. Your principal in a fixed annuity, though, here's what's nice. Your principal does not fluctuate and only increases based on annual interest paid by the insurance company or decreases by withdrawals by you, the contract owner. Okay, so we'll illustrate that. That's a nice feature about those. Bond index fund has daily fluctuation, no guarantees to principal or interest, right? And a money market fund, although the fund seeks to preserve the value of your investment at $1 a share, I cannot guarantee it will do so. Although the fluctuation of a fixed annuity and money market fund, I've never seen either one fluctuate. But I'm saying I've never seen that. But it's still possible, at least in the case of a money market fund, less likely in a fixed annuity. Tax features, we're talking about all taxable products here, so no municipal products. These are fully taxable products, and so inasmuch as that's the case, the bonds distribution may be taxable as ordinary income. It's probably taxable as ordinary income, but someone listening here could be in like a 0% tax bracket, so may be taxable, right? If you're investing through a tax advantage account such as an IRA or an employer-sponsored retirement or savings plan, special tax rules apply. Well, in an IRA or tax-deferred account, all interest is tax-deferred until you make a withdrawal, and then you have that tax penalty if you're under 59.5. But if you're buying this in a taxable account, when a bond pays interest, it'll be taxable for that calendar year when you do your taxes the following April. Same with the government bond. The bond's distributions may be taxable as ordinary income, and if you're investing through a tax-advantaged account, such as an IRA or employer-sponsored retirement or savings plan, special tax rules apply. Same as what I just went into for the corporate stuff. Fixed annuities, taxes on any gains are deferred until monies are withdrawn. Gains are taxable at ordinary income rates, and all withdrawals from annuities purchased within an IRA are taxable at ordinary income rates. All right, so an annuity, a fixed annuity, you have this ability to reinvest your interest and allow it to maintain its tax-deferred status. Or if you want your interest paid out every year, it'll be taxable in the year that it's payable to you. So fixed annuities have sort of like a reinvestment program or not reinvest program. So if you reinvest, they're tax deferred, and if you don't reinvest, it's currently taxable. And if you buy an annuity in an IRA, whenever you take money out of the IRA rules kind of supersede or trump annuity rules. So whenever you take money out of an IRA, it's taxable. Under 59.5, it's taxable with the penalty, et cetera, et cetera. But fixed annuity can defer the interest on a tax-deferred basis or take it into your pocket every year. And when you take it into your pocket, it's taxed in the year that it's received. So a bond index fund, bond funds and money market funds, again, when they pay interest, you have a reinvestment option. So in a bond index fund or a money market fund, the fund's distributions may be taxable as ordinary income or capital gain. If you're investing through a tax advantage account such as an IRA or employer-sponsored retirement or savings plan, special tax rules apply. So in a bond index fund and a taxable account, whether you reinvest the interest or not, that interest is taxable in the year it's received. An annuity can remain tax deferred, but a bond index fund and a money market fund, again, whether you reinvest or not, doesn't matter. Those interest payments are taxable in the year received. Let's just read the money market fund to get through this slide. The fund's distributions may be taxable as ordinary income or capital gain. If you're investing through a tax advantage account such as an IRA or employer-sponsored retirement or savings plan, special tax rules apply. All right, so these are the SEC requirements to discuss these 7 components when you do an investment comparison, right? These are 7 components I have to touch on. So hopefully that was, if you're seeing this, that was adequate. 2 other components I thought I'd put in, since this is not an SEC requirement, but helpful to know when you compare products. I talked about this a little bit. Can you reinvest the interest? Corporate bond and government bond, no. I'll show you how that works graphically in a moment. But you cannot, if you buy an individual corporate bond or an individual government bond, you cannot reinvest the interest into that same security. A fixed annuity you can, a bond index fund you can, and a money market fund you can. Beneficiary protection. Hey, if something happens to you, what happens to your money? In a corporate bond, some corporate bonds have beneficiary protection. They're called survivor's options or death puts. Some, not all. You got to read the prospectus. You got to ask your broker. I'm just saying some, not all. Please, some, not all. Some corporate bonds have survivor option, which means if you buy a bond and you pass away, if it's worth less than face value, your beneficiaries may get back face value of the bond. So you put $10,000 into a bond and you pass away when it's worth $9,700. Some bonds, if they have a survivor's option, will pay you back the full $10,000 face value. Now, my understanding is depending upon the issuer, it's not seamless. You have to prove perhaps death certificate. There's some paperwork involved, and I can't say how long it will take, 30, 60, 90 days, depending upon the issuer. But in some cases, if you want this feature, research it, look into it. Some corporate bonds have survivor's options. Government bonds don't. Fixed annuities do. They have beneficiary benefits such that your beneficiaries are guaranteed at least what you put into the product, where a bond index fund and a money market fund, again, have no beneficiary guarantees. All right, so appreciate you bearing with me during those disclaimers. And there was some good information in there that I got into. So I think at this point what to do is let's get into the functionality of these, because obviously when the rates are different, you'd think it's easier to buy these products, right? Make the investment, go for the one with the highest rate. But I think the functionality and the predictability are also significant factors. Now that the rates on these products are nearly aligned, I think that the functionality and predictability are going to be helpful to know. Just so you know how to use these products. So let's get into it. Here's my best graphical representation of the functionality of government and corporate bonds. All right, so this is just functionality. Again, credit differences, liquidity differences, but functionality, that they work the same. Right, all of these bonds, and we're going to assume that we're buying these bonds when they're issued, and they're 5-year bonds, bonds that mature in 5 years. That's it, straightforward, right? Bonds are issued in $1,000 increments for the most part. So if you buy 5 bonds, you pay $5,000, 25 bonds, $25,000, 100 bonds, $100,000, etc. When you buy a bond, the coupon is stated, and so you know your interest rate. Hey, you're going to buy a 5% bond here. You're going to get 5% a year. Well, you will, and they pay you every 6 months. So if you buy a 5% bond, you get 2.5% every 6 months. So that's 5% for the year. With individual bonds, all of these percentage signs are meant to be the same size, because when you buy a fixed bond, your interest rate does not change and your interest payments do not change. You receive the same half year's worth of interest every 6 months. So again, a 5% bond pays you 2.5 in 6 months, 2.5, 2.5, 2.5, 2.5, 2.5. Now, so that's why I say the predictability of these is extremely high. You put in $100,000, you're going to earn $2,500 every 6 months, $5,000 a year for 5 years. And then what you need to know is whether it's a corporate bond or a government bond, this is the market price. The market price is going to fluctuate throughout your holding period. Whether it goes up or down, it's going to do both. Whether it goes up first or down first, I can't tell you. But if you buy a bond that performs as expected, you will put in money at the start, your principal, and you'll receive your principal back at the end of 5 years, and you'll receive the same fixed interest payment along the way. Now, that's even if, right now we've heard so much about interest rates. Just to make sure you're clear on one thing. It does not matter what happens to interest rates when it comes to redeeming your bond. If you've put in, just say, $100,000, your $100,000 will fluctuate, and it doesn't matter if rates go down such that your bond goes up, or if rates go up such that your bond at first goes down in value. As you approach maturity, your bond, whether it has increased or decreased in value, at the end of 4 years, between year 4 and 5, it's going to come to its maturity value, come back to par value for the end of that 5th year. So your bond will change in price every day. You can sell your bond. And that's another thing, right? Liquidity. You can sell your bond in the market. Anytime the bond market's open, you can sell your bond. You can sell it for more, or you might sell it for less, right? If you have to get your money back, I can't tell you ahead of time how much it's going to be at any given point in time. Simply unpredictable. But I can tell you that your par value when you start, or your par value when you finish, will equal your par value when you start. You'll get consistent interest payments, but you don't know what your market value is along the way. So if it's important to you to know what something's going to be worth at some point in time, just know that this may not be the product for you. If you need to know that your principal will be worth the same in 3 years, we'll buy a 3-year bond. Don't buy the 5-year bond. But just know if there's an emergency and you need to get money out, your bond could be worth more or less than you first put in. However, if you hold it to maturity, it will be worth, as long as the bond performs as expected, it'll be worth its par value when it matures. And so that's how a government bond or a corporate bond is highly predictable when you make the investment, because you know the interest rate and you know when you're going to get your money back. That's what makes it predictable. Now, if we go, that's in contrast, let's call it, to a bond fund. A bond fund doesn't have a par value. You just say you put in your $100,000 when you start. It's called an initial investment. And you'll notice that these percentage signs, these indicate these, just hypothetical interest rates along the way. Maybe your bond was paying you 5% when you started, all right? And then you got paid more in interest, more, and then you got paid less, and then more, and then less for some amount of time, and then more again. The interest payments of a bond fund are not predictable. They're predictable in that as interest rates go up, you'll get paid more, and as interest rates go down, you'll be paid less. But at the same time, that's the thing, as interest rates, if interest rates go down, your fund will go up in value, and if interest rates go up, your fund will go down in value. Now, in both cases, you'll have offsetting interest, but I can't tell you at the end of like this 5-year period that we're talking about today, I have no idea what your bond fund is going to be worth or what the interest rate is going to be after 5 years. I can't even tell you that what it's going to be here if this is the 5-month mark. I can't even tell you after 5 months what it's going to be worth or how much interest it'll be paying. Just no one can tell you. Now, over a longer term hold, yeah, you're going to have more than likely your bond fund will increase in value. There's a higher probability. The longer you hold your bond fund, the higher probability that you will have increased your investment over that time, right? So the longer you hold it, the higher the chances that your bond fund will have increased in value, whether through principal or interest or the combination of both. The longer you hold a fund, the higher your probability of success is. I think that's fair to say. But in the interim, super unpredictable. Once you put in your money, you will not know what it's going to be worth at any point in time. You just won't know. It's not as predictable as an individual bond. Or, better yet, let's scroll down. A money market fund, right? A money market fund, again, no par value, but you put in your initial investment. Let's just say this $100,000 I've come up with. And, excuse me here. All right, so you've put in your money into the money market fund. Get my marker back. The money market fund, your original investment or your investment should never go below your original investment unless you've taken out money. Money market funds seek to preserve a $1 per share NAV and seek to never change from that amount. And they'll pay out interest monthly. Now I've shown kind of yearly things here, but your money market fund, the expectation is that it only goes up in value when it pays interest. Now, the interest rates will change. If interest rates go up, it'll pay you higher interest. If interest rates go down, you'll earn less interest. However, money market functionality is such that your money market fund will never fluctuate in value, simply increase as interest is paid to the money market fund. Now, again, it's not often that money market rates, bond rates, and fixed annuity rates are nearly even for 5-year periods right now. So we're not often in this situation. So money market funds, the rates will increase faster and decrease faster with announcements by the Federal Reserve. If rates go up, your money market fund's going to pay you more next month. If rates go down, your money market fund's going to pay you less next month. And that change is going to be a faster change than your bond fund. And again, your corporate bond, government bond, individual bond won't change rates as interest rates change, but these funds do. Money market funds have daily liquidity. I have not had someone be imposed a surrender fee for a money market fund, but they've been basically, money market funds have now tried to protect themselves, and they can impose redemption fees in in what I would think would be an extreme circumstance, and that's to help preserve. I mean, their goal is to preserve your principal. That's their goal, right? Their goal is not to pay the highest interest. Of course, to be competitive, they need to, but they won't say that. Their prospectus goal is to preserve a $1 NAV and pay periodic interest. So you can sell your money market, buy and sell your money market fund every day. Interest rates fluctuate every month, but your principal, the goal is that your principal is never reduced and that your investment value only increases with interest payments and decreases with withdrawals. So that's how money market funds are desirable, but they also have the most volatility in rates and be very, very difficult for the same rate, no matter what the level is, very difficult to have the same rate for a 5-year period on a money market fund. Probably not going to happen, just it could, but very difficult. All right, so then let's get into fixed annuity. Okay, so some important things to see here. Let me move. Okay, I'm out of the way for all the graphics. In a fixed annuity, again, no par value, but you have your initial investment. Wow, that's a big one. How do we make that smaller? Have your initial investment, let's say it's your $100,000. And the functionality of a fixed annuity is such that it protects your principal and that the goal is that it only increases as interest is paid and it never decreases in value. That's similar to a money market fund, I'd say. All right? Except that when you buy a fixed annuity, also your interest rate is fixed for the term you select. Now, today we're focused on 5-year fixed annuities. You could buy a 3-year fixed annuity. There are 7s and 10 years. They're also kind of common fixed annuities, but today I'm focused on 5, right? This is just a 5-year comparison. All right? And so when you make your initial investment into a fixed annuity, your interest rate, your principal is known and your interest rate is known, and typically fixed annuities pay interest once a year, typically. Now, I've seen that become sped up. Some are paying monthly and semi-annually, but I would say it's fair to expect it to pay interest at least once a year. Then your account value increases as interest is paid, and your account value only decreases if you make a withdrawal. All right, you will not see fluctuation of principal as such with bond funds or bonds. Your principal is fixed and it pays interest. Now, in return for that predictability, the potential cost to a fixed annuity is if you need money sooner than the deal. Again, today we're focused on, where's my darn pen, a 5-year deal, right? So you put in money, and at the end of 5 years, if you do nothing, you will get exactly as the product is designed. However, if you have to take out money anywhere along the way, this is the downside. You can sell all of your fixed annuity every day the insurance company's open, and you can ask for all of your money back, whether it's day 180, day 730, or however many days are in, I can't help myself, 3, 6, 9, but 1095, 1095 days into it. Any day that the annuity company's open, you can call and ask for money. However, to get all your money back. So it has daily liquidity theoretically, but it comes with a cost, okay? Most fixed annuities will allow you to take out approximately 10% a year of your contract value, 10% a year of your contract value with no penalty. So say you have a 5% fixed annuity and they typically compound interest, but I can't do compounding interest in my head. So after 4 years of 5%, you should have about $120,000 in your fixed annuity. And if you need money, the insurance company will say that you can get, 10% of this, right? 10% of this, which is $12,000, right? You can take out $12,000 with no penalties or fees, and it doesn't break your deal. However, they will impose what's called a surrender schedule on the amount above the free amount that you can take. So in this example, here's the surrender schedule. Anytime you take money in the first year, more than 10%, more than the free amount, the amount above the free amount that you take incurs an 8% surrender schedule. So if you take out $10,000 more than the free amount, you're going to have an $800 fee to withdraw your money, right? Sort of like breaking a CD, but fixed annuities aren't CDs, but everyone knows that if you break a CD, you don't get as much interest. There's a penalty to redeem your CD early. Everyone seems to know that. There can be a penalty to redeem more than 10% of your fixed annuity prior to the end of the term. Surrender schedules are typically steep, and they typically look like this: 8% to take more than permitted in the first year, 8 in the second, 7, 7, 6, and then after 5 years, there's typically no surrender schedule on a 5-year annuity. Now, if you have a 7-year annuity, the surrender schedule keeps going. A 10-year, it keeps going, but at the end of the term you've agreed to, your surrender schedule should be 0. But along the way, we would say in the industry 88776, and we know that after, still if you're within 3 or 4 years of owning this thing, it's still a 7% surrender above the free amount. And here in this example, at the end of 4 years at 5%, you should have $120,000 in account. You can take out $12,000 with no cost. But say you need $20,000, so then $8,000 gets a 6%, a $480 surrender fee. Again, so not all $20,000. You need $20,000. Only 8's in excess of the free amount, and 8 times 6% is $480. So just know that if you need to take out more than 10%, there's going to be a penalty for this early redemption. And not to say it's a bad thing. I mean, you had an emergency. What are you going to do? You had to take your money out. But just know going in. I mean, so you get the benefits of, fixed principal, an account value that only increases as interest is paid. But the downside is if you need money sooner than the end of the term, there's going to be a penalty to redeem your money. Now, there are some outs with this for healthcare concerns, right, or required distributions from IRAs. But those are exceptions. You need to know going in that if you break the deal early, a penalty, you could be assessed a penalty. All right, so I think that's important to know. But again, it's the functionality of these products. The functionality of these products is what's helpful, and I think will be, considering the fact. Let me get this back on me. Considering the fact that these products for 5 years all have extremely similar starting rates, it's going to be very difficult to say who's going to be the winner after 5 years, but they might all come in very close. So I really do think that the functionality of the product and how it's going to perform over the 5 years and its predictability, I really think those are super important features to know right now when you're comparing or evaluating or trying to decide amongst these particular options. So I hope you found this helpful. That's all I got. See you back here next time.